Hey everyone, welcome back to another video. In this video, we're going to reveal a powerful strategy for trading supply and demand. Not being aware of this could leave you at a significant disadvantage consistently trading against large financial institutions and smart money. We'll cover key concepts in this video. So what exactly are supply and demand zones? The area below where the price reverses to the upside is known as a demand zone. Notice how price reacts to these demand zones. Think of it as a general area where price has previously reversed. Demand zones are where major banks and institutions view the asset as undervalued, giving higher chance of buying or longing the asset. This results in the price of the asset moving towards the upside. This happens because of two reasons. Institutions are opening more buy positions, giving strength to bulls, and institutions are closing their sell positions, weakening bear strength. Now, the zone above, where price reverses downward, is a supply zone. Price often reacts to these supply zones, demonstrating their importance. Supply zones are where institutions consider the asset overvalued and opt to sell or short the asset. As price could revert to the downside, this happens because 1. Institutions are closing their buy positions, weakening bull strength. And 2. Institutions are opening sell positions, increasing bear strength. Let's look at more examples. Also, we usually draw these zones with the rectangle tool in TradingView. In this case, the zone from the above is our supply zone. We can see it by the many rejections it had, and the zone below is our demand zone, seen by price reversing to the upside when it touches our zone. Now that we know the basics, we need to get to the next level. Supply and demand zones are dynamic, meaning supply zones can become demand zones, and demand zones can become supply zones. Initially, this was our supply, and this was our demand. Once price breaks one or another, the zones flip. Let's make it more clear. We see how price breaks our supply zone to the upside, then it becomes a demand zone. What happens on demand zones? Price goes up when hitting our demand zone, and we see that is what happened here. Let's quickly repeat this process. Price broke up the supply zone. Then it became a demand zone. The next candles hit our demand zone, and price aggressively goes to the upside. It can also happen in the other way. As an example, following the rule of the dynamic zones, we know that if price breaks one zone, they flip. This is our initial supply, and this is our initial demand. After tapping the demand zone multiple times, demand zone fails to support and price breaks down. And now this zone becomes a supply zone. What happens when price hits a supply zone? Price goes down. And we can see that what happened in our situation. Every time price hit the new supply zone, it went down. As we mentioned in the beginning, it is crucial to know this. Why? You might ask. We are only a small portion of the volume traded, so us traders can't move the market. Most of the volume is given by institutions such as banks. They are the ones that move the price. By knowing this, we can recognize what the banks are doing, and our intention is to follow them. Institutions do not buy or sell at random prices. They have a strict plan to get the best prices available, and they are not afraid to even manipulate the price into their advantage. The strategies presented in our videos reveal the institution's footsteps, and all we need to do is to follow them. Now, there are confluences that can increase accuracy in trading supply and demand zones. Let's look at another example and dive into detail. This is our supply, and this is our demand, as explained in the last part. Our price breaks down the demand zone and it becomes a supply zone. Also, price has formed a demand zone here below. See something different. Price has broken down below the demand zone, but failed to continue lower. This confluence is called a fakeout, and we need to learn how to spot these movements to 1. Lose as less possible, and 2. Win as much as possible. The secret is having patience to see how price reacts on the retest of the zone. If price manages to go above the candle that initially broke the zone, we can be confident that this was a fakeout, and we are likely to move to the upside. Then we break the supply afterwards, and zone act as demand. In this situation, we do not have a fakeout, and we can spot it by the candles forming higher highs and higher lows. We call it uptrend. Eventually, price hits the next supply, where we would like to sell short. Another example of a fake out. This is our supply zone. This is our demand zone. Price goes down after hitting supply, but eventually it breaks. But as we can see, it has failed to continue to push higher. How can we profit from this situation? We look for a red candle to cover the candle that lead to the break of the zone. If price goes lower than the candle that has caused the breakout, the odds are the given asset has failed to break out, and we should be prepared for banks to hit and break down the next demand zone available. The next confluence is time frame analysis. We start by moving to a superior time frame and identifying the macro trend. In case of a downtrend, we should be looking to sell. Therefore, we want to spot our supply zones. In a downwards market, the higher likelihood is for price to continue to go down. So we don't want to time the market, we just want to follow the market. The opposite happens if the macro trend is to the upside. Let's quickly recap. 1. Move to a high time frame, usually daily or weekly. 2. Spot the overall trend. 3. Focus on the zones according to the trend. Downtrend? Focus more on supply zones. Uptrend? Focus more on demand zones. This is an example on how to do the time frame analysis confluence. This is the gold chart on the hourly time frame. Looks confusing, right? As we learned before, we want to move to a high time frame, such as the daily time frame. Now it's much easier, isn't it? We can clearly see what type of trend gold is following. Price puts higher highs and higher lows. This is an uptrend. So what zones do we look for on uptrends? We look for demand zones. If it's hard for you to recognize the zones, do not worry. The more experience you will have, the easier it will get. This is our demand zone. Why, you might ask? Because we clearly see this used to be a supply zone that price broke to the upside. What happens when a supply zones break? It becomes a demand zone. See how we can apply information that we already learned? Now we just need to have patience for gold to come at this price, and we look for potential buy opportunities. I repeat, patience is very important. The opposite can also be done. This is the Tesla stock on the daily time frame. We see that it follows a downtrend. Knowing this, we can go on lower time frames to look for supply zones to sell. This is the hourly time frame for Tesla. Up is supply, down is demand. Notice how price broke out but failed to continue. As we already learned, this is called a fake out. Currently, Tesla has rejected again from the supply zone, so we would like to sell short and expect price to break the next demand zone. This is the mastery of supply and demand strategy, when you can apply multiple confluences for extra confirmation. Thank you for watching. If you found this video helpful, leave a like, a comment, and subscribe to get notified when we post our new videos.